Hey everyone, do you know why I'm holding this wet blanket? This is what's driving the stock market. Wet blanket. I'm gonna take you into my lab right now and I'm gonna show you why. All right, we're back in the lab, and the topic of today's conversation is wet blanket or interest rates. For those of you who are not familiar, typically interest rates and stocks trade inverse to each other. What does that mean? Interest rates go up, stocks go down. And when interest rates go down, stocks go up. Right now, what we're looking at is the Fed's minutes. This is what the Fed is thinking in terms of interest rates and where they're thinking they're going to go. The Fed believes that rates are still too low, or the majority of the Fed believes the rates are still too low and they need to go a little bit higher. As you could see here, stock markets mostly dipped on Thursday on news that some policymakers at Federal Reserve think interest rates should continue to be raised until they're slightly restrictive. And what did that do? That caused the Asian markets to decline in value and the overnight markets in the US to decline as well. But I want to show you something very, very important. If you look at the interest rate yield, right now we're looking at the 30-year and we're looking at the 5-year and the 10-year. Interest rates on the 30-year went from 2.80 to 3.35. Not a major increase. The 1-year Treasury yield, 141 to 266, slightly higher, but not anything crazy. If you look at the 30-year fixed, we went from 3.65 to 475. Now, my question to you is this. Have you ever seen a market crash with interest rates being below double digits? I haven't seen one. Interest rates just started rising. What does that mean? It means the Fed has a lot of flexibility. If stock market comes down a bit too much, they can lower the rate of increase. So right now, I'm not seeing interest rates being a major catalyst. If you look at the 10-year Treasury yield from 2009 all the way to 2018, you'll see that the difference is just not that significant. We're not seeing rates go above 10% or 12 or 15%. Money is still cheap. And if money is still cheap, stocks will go up. It's that simple. And once again, to summarize, interest rates and stocks trade inverse to each other. When interest rates go up, stocks go down. When stocks go down, interest rates go up. Interest rates are still near historic lows. We're not going anywhere too far just yet. We're still in the base stage of raising rates, folks. So stocks still have quite a bit to go before peaking out. I'll talk to you soon. If you enjoyed today's tutorial, I want to hear from you. Please send me an email. I want you to be part of the conversation. Roger@wealthpress.com. I look forward to hearing from you. Talk soon.